I'm Nick Grove for Morningstar.com.au, and today I'm joined by Morningstar's Head of Equities Research, Peter Warnes, who's here to discuss the latest earnings season, which got well and truly underway this week. Peter, welcome.
Thanks, Nick. Lovely to be here again.
First of all, Peter, near the beginning of the week, we saw Cochlear and CSL, two big Aussie healthcare companies, report their half-year earnings. Were you pleased with the dividends they paid and the general composition of their results?
Nick, conflicting reports. Cochlear result was pretty reasonable after some problems last year with recalls and provisions. Revenue up 18%, and importantly the dividend is now back into the traditional 70% payout range after pushing well above 100% last year. But that result was good take up from new launches in 2014, pushed the revenue right along. And there's new launches, particularly in those big markets in the US and Europe for second half. So we expect the momentum in sales and in profits to continue, albeit that we do think that stock's a little expensive at this point in time. CSL was a different kettle of fish. The result was good. Profit was up 9% in constant currency terms, and the dividend was similarly up 9% to 58 cents a share US. Look, the key to that result was that the hemoglobin sales were a little bit less than we expected, but in China in particular, albumin take-up was very strong, but the hemoglobin sales that was just off the pace a little bit, that caused the management to just ease back on their growth prospects from 12 to 10% for the year. The market pulled back on that downgrade, and we see that as an opportunity. So don't be scared about a slight downgrade in CSL. It's a great company. The world needs plasma. It's a growth market, so opportunity.
Peter, on Wednesday we saw Commonwealth Bank deliver yet another record profit with positive jaws backed by all the usual key drivers. Can the good times keep on rolling for CBA?
Nick, that's a $64 question, isn't it? Look, CBA ticked every box it was worth ticking on Wednesday. Whether or not they can continue is a moot point. We think they can because, look, these are not boom conditions. The conditions aren't about to fall off a cliff. The economy is under trend. And yes, it can drift a little further from here, but strangely enough, volume growth in credit is still quite reasonable. At around about 5 or 6%, and that's likely to continue. I mean, the push in home building and activity is not about to fall over. Lower interest rates, increased product affordability, that's not going to change in the near term. And so, yes, for the next couple of years, CBA and the big banks are in a sweet spot, really. They're being able to extract a lot more efficiencies out of their organisations, and the volume growth is allowing cost efficiencies to be pulled out, and that's driving down the cost to income ratio. So, one of the levers there is still a reduced cost base, and as you said, positive jaws, i.e. that the revenue is increasing it faster than the cost base. So that's the lever that they're pulling at the moment. Whereas the bad debt lever is there's probably no more room to move there. So look, I believe that they can continue to push ahead at around about 6 to 7% growth in earnings, and importantly in dividends. I mean, the profit was up 8.3%, the dividend was up 8.2%, the payout ratio's holding around that low 70 mark, capital's good, liquidity's good. I mean, yes, there can be some clouds on the horizon, but I don't think they're all about to wash this party out in the near term. Still positive on Commonwealth Bank, a little pricey at these levels, but the dividend is sustainable, we believe, at the current rates.
Peter, Thursday saw Telstra deliver its half-year earnings, and as expected, it paid a 15-cent dividend, but reaffirmed its guidance for flat full-year earnings. Are you disappointed with this guidance?
Nick, you've just got to be a little careful there because we've got to get like with like. Don't forget CSL, the Hong Kong mobile business, is out of it now. And so let's get back to underlying earnings. And so yes, whilst they might have given you a guidance of flat EBITDA at the top line, it's better than that. If we strip out CSL, the first half revenues were up 6.2% and underlying EBITDA was up 3.4%. And we would expect that to continue. That momentum in the business is quite strong, driven by mobiles and NAS, and there's no problems there. We think there's momentum starting to build in Telstra, and so no, the guidance was top line rather than underlying, so we're going to be there. And the mobile performance was outstanding. I mean, revenue up 9.6%, and they've got 16.4 million mobile services in operation. Think about that and think about how many people are in the country. But more importantly, the revenue is starting to kick in. See, what's happening is that the growth in mobile take-up, in other words, the growth in their number of mobile subscribers, is slowing. I mean, because at the end of the day, you know, a big number, you just got the percentage growth slows. But what's happening now is the average revenue per user, the ARPU, is increasing. So you're getting a kick on the price side now, which wasn't there in the last couple of years. And what's that come back to? It comes back to the network. You've now got 4G and 4GX. What's happening is that people are upgrading, and as you upgrade, you go to higher tier plans, and that kicks up the revenue per user, and that's the secret to it all. Now there are, you know, suggestions that Optus is now going to walk into the, you know, get a bit muscly and all that type of thing. The fact remains is that their network isn't anywhere near the quality of Telstra, and yes, they might get some subscribers coming in on lower price plans and what have you, but in mobile it's all about the speed of the delivery. It's not so much getting something and downloading it and taking a half an hour to get it down. It's speed, and these guys who have got the money want the speed, and that's where Telstra is in the sweet spot. So I would expect, you know, the dividend to be a little higher in the second half, not getting carried away. The free cash flow generation is still very strong, 4.6 to 5.2 billion guided. That is going to continue. The NBN rollout payments are starting to filter through, 385 million in the half. Look, you know, Telstra's is looking good. We've upgraded there, and at a 5% fully franked yield in this environment, that's not too bad.
Peter, thanks very much for your time today.
Pleasure, Nick.